We've pretty much finished with financial accounting for this course. This course, as you know, is a hybrid course, and we cover financial accounting, managerial accounting, and finance all in one semester. That's a lot to cover, so we move pretty rapidly, and the first half of the course is devoted to financial accounting. And having done the common sizing assignment and having taken your first quest, you've pretty much completed that part of the course. Hopefully you have a pretty good understanding at this point in time of how financial statements are derived, where they come from, and how they're used, and how they're interrelated, and how you can use them to understand the functioning and financial position of an organization. So now we're going to go from there to a combination of finance and managerial accounting. And this is quite different. Your financial accounting is constrained by rules. We have to follow GAAP rules in the US or IFRS rules internationally. There's formats that we have to follow. You may have noticed when you did your common sizing that all of the financial statements look sort of the same for different types of companies, and you should be at this point pretty conversant with that format. You should know how to read a balance sheet. You should know what an income statement tells you. You should know what the statement of cash flows tells you. That kind of information is really important. And as you move on in your business careers, you're going to run into this stuff over and over again, and being conversant with it, understanding not necessarily the nuts and bolts too much, but understanding where the numbers come from and how they're used and what they mean. Really necessary if you're in any kind of a business organization in a managerial role. So now we're going to go on to the finance and managerial accounting side of this, which is a little bit more free-flowing. We don't have a lot of rules that we have to follow. Managerial accounting is about using accounting information to make decisions. Finance is about structuring a business so that you have the capital necessary to run the business, and that you run it in a manner that is efficient and profitable for the owners. So we're going to jump back to chapter 5 now in your textbook and sort of take a look at capital structure. Where does money come from, and how do we use it? So this, to a certain extent, is the equity portion of the balance sheets that you've been working with in financial accounting. And we haven't gone too much into depth about how that money gets on the financial statements, but we're going to try and do a little bit of that now. So where does an organization get its money from? What's its capital structure? Every organization needs resources to acquire assets necessary to operate their business. So we have to have resources, which is generally money. It doesn't have to be money. It could be other assets that we can trade for the assets we need. But in general, generally speaking, it's going to be money. And where do we get it? So that's the definition of capital. And it shows up on the balance sheet, as you all know, on the liability and equity side of the balance sheet. So capital provided by creditors is liability. So people who lend us money or offer us credit provide capital so that we can acquire assets. And then stockholders also provide capital so that we can acquire assets. So the capital structure is on that right-hand side of the balance sheet. Of course, the left-hand side of the balance sheet is the things we use the capital to acquire. That's your assets. Businesses can be organized in lots of different ways, and we're going to look at small business and large business. Small businesses can be organized as sole proprietors, partnerships, LLCs, sub-S corporations, or C corps. Now that's 1, 2, 3, 4, 5, 6 choices for an organization. And the differences between those organizations, the first two, sole proprietor and partnership, are creatures of the owners. So the owners and the corporations and or the organizations, the businesses are not separate. They are one and the same. So a sole proprietor and the sole proprietor's business, there is no distinction between the person and the organization or the business. Might be a very large business, but it's still a creature of the owner, the sole proprietor. A partnership is the same, except you have multiple owners. But the owners in partnerships are also the same as their business. And what that means is if the partnership, let's say, owes money to someone else, has a liability, that liability is not the organization's liability, it's the owner's liability, whether it's one owner or multiple owners. So there is no difference between the two organizations, the business itself and the individual. LLCs, sub-S corporations, and C corporations are all corporate forms of government that have limited liability. Essentially, the owners provide capital, but their risk is only to the extent of the capital they provided. Their personal wealth, their personal assets are separate from the corporate assets. So the corporation has the ability to, the LLC, sub-S, or C corp has the ability to enter contracts, has the ability to hire and fire and so forth. And the owners, the equity holders, have control of the corporation, but they do not have unlimited liability for the corporation. The liability is limited to the amount that they've invested. So very different types of organizations. And we'll talk about what the difference between LLCs, sub-S's, and C corps are in a bit. Most small businesses get their money, their capital, from family, friends, banks, or money that they earn and retain in the business. So that's kind of the sources for most small businesses. We're going to provide, our family's going to provide the capital to start this business or run the business. Our friends, people that we know may invest in the business with us. Banks can provide capital. And then if we earn money, we can leave it in the business, and that's additional capital. So that's usually where money comes from for small business. There are also venture capitalists and private equity funds that sometimes provide capital to small business as well. Not as frequently. Private equity funds and venture capitalists generally are looking for scalable businesses that are growing quite fast or can have the ability to grow fast. Because that's how they are able to cash out of their investments over time. Not-for-profit organizations often get their startup capital from donations. They may also go to banks or other lenders for capital, so they may take on debt. And they also call it retained earnings for nonprofits, but reinvestment of net revenue is another source of capital for not-for-profits. Not-for-profits are not all that different than for-profit organizations. They pretty much function the same way. They have to have generally positive net revenue in order to exist for a long term. The only difference is that they do get their capital as donations as opposed to investment. And then for-profit corporations, which you just analyzed a couple of them when you did Tidewater and Kirby. First of all, they do provide limited liability. The owners are only liable for the amount that they have invested. They tend to be quite liquid if they're publicly traded for-profit corps. Owners can buy and sell shares of the organization. The only amount they have at risk is the amount invested, as I said earlier. And the financing comes from selling stock, which we call issuing stock. That's equity financing. Loans, which is debt financing, and retention of earnings. So same thing as the small business organizations, the sole proprietorship and the partnership, except here we have limited risk and liquidity. So if a partner, or let's say a sole proprietor, sells his business, he's no longer there, and that changes the structure of the business dramatically. But if I own 20% of a company and I sell the shares, it doesn't change the corporation at all. The corporation doesn't care who owns the stock in the corporation. So I can trade the stock outside the corporation and it has no effect on the operations of the corporation, or at least no short-term effect. So common stockholders in the corporation, they own a proportional share of the corporation's assets. They are the owners of the corporation, so they have the right to vote to elect the board of directors, and the board of directors is the owner's representative that then goes and hires management. So the board of directors is the controlling force in any corporation, corporate governance, and the board of directors is elected by the common shareholders. Common shareholders are entitled to a proportionate share, depending on how many shares they own, of dividends and any liquidation proceeds. And they can sell their ownership interest with no impact on the entity. And they have limited liability. When common stockholders invest, what they get back for return on their investment, it either comes from dividends paid out or increases in the value of the stock. So if the company doesn't pay out dividends but instead reinvests the money, then the corporation's stock presumably will grow in value if the company is well run, and that is part of the return that a common stockholder gets. So their stock perhaps becomes more valuable, and if the company pays dividends, they also get a current monetary return on their stock holdings. So companies sell common stock, or the financial word is issue common stock, to raise money for a new company, and that's called an initial public offering. So we've seen some IPOs in the recent past for Facebook, did a large IPO a couple of years ago. Somebody just did an IPO, one of the big tech companies, I forget which one, in the past 12 months. So IPOs we're going to raise money for a new company from the public, called initial public offering. We sometimes issue common stock to pay for an acquisition. So we may want to buy another company, and we give the shareholders of that company our common stock. So we issue new stock, and we get in exchange the stock of the company that we're trying to buy. We become the owner of the company we're trying to buy. Sometimes we issue new common stock to raise additional capital. That's not as common as the first two, because it is diluted. If I sell more stock, that means my current shareholders end up with less ownership interest in the company. So I get cash coming into the company, but I also dilute the ownership interests of my current stockholders. So if there were 100 shares outstanding, and I sell 20 new shares to a new stockholder, now there are 120 shares outstanding. So my old stockholders, instead of owning 100% of the stock of the company, only own 80% of the company at this point. So there's a dilutive effect by raising additional capital by selling stock. And then finally, very common for companies to issue stock to employees as part of a compensation plan. So stock option plans are very common, especially for senior employees in many public companies. And part of your employment contract, you get paid a salary, and you also get a stock option, which is the right to buy a stock at a certain amount of money sometime in the future. So today's price, 3 or 4 years from now. So if you do a good job, you run the company well, the stock price increases, you can still buy it at the old price and the price today, and you can buy it 4 years ago at that price and have a significant gain on that. Of course, if you don't do a good job and the company doesn't increase in value, then your stock options are not worth anything. Dividends, when they're paid, the board of directors votes to pay them, so there's no requirement that dividends get paid. Some companies pay dividends every year, and you might assume that they're going to pay dividends, but there's no requirement. Good example of that would be General Electric. General Electric from somewhere around in the 1930s until 2007 paid dividends every single year, and every single year they paid a slightly larger dividend. So their dividends increased every year, and they always paid dividends. And in 2008, they didn't pay any dividends. With the financial crash, they had a large finance arm that had suffered substantial liquidity issues, and the board of directors said, we can't afford to pay to pay dividends to our shareholders. We have to hold our cash in order to maintain the solvency of the company. So they didn't pay dividends, even though they paid them for 85 years or 80 years or something in a row. They didn't pay them. So you can't count on dividends. It's voted by the board of directors. When dividends are paid, they're paid to shareholders of record. And there are 3 dates whenever dividends are paid. There's a date that the board of directors declares the dividend. There's the record date, and the record date is the date that whoever holds the shares on that date gets the dividend. And then there's another date, the date that the dividend actually gets paid. So if the board of directors votes today, or let's say the board of directors votes on January 10th to pay dividends, they'll say we're voting to pay dividends for the first quarter, and we're going to pay them on to shareholders of record on February 1st, and we'll actually pay we'll distribute the dividend on February 15th. The date we declare it, it becomes a legal responsibility for the company to pay it. The record date really doesn't have anything to do with the company other than determining who we're going to pay it to, whoever owns the stock on that date. And then the distribution date is the date that we actually cut the check to you as a dividend check. There's absolutely no responsibility or requirement for companies to pay dividends, and dividends are a return of capital. They're not an expense. So what they are is a money that already belongs to the shareholders, and now we're going to actually give it to the shareholders. So that's what dividends are. Dividends from C corporations, from regular corporations, are subject to double taxation. The dividends are distributing earnings that the company made and earnings that were taxed at the corporate level, but they're taxable to the shareholder who receives it. So we paid tax on it when the company earned it, and now when we distribute it, we're going to pay tax again. We call that double taxation. And dividends are not an expense for the corporation, so they're not deductible for the corporation. So that's why that ends up being double taxation. However, for some companies, the tax code allows for different kinds of corporations. So earlier I said there are things called LLCs, or limited liability corporations, and subchapter S corporations. Both of those types of corporations are addressed in the U.S. tax code. And what they do is essentially the earnings of the corporations are taxed directly to the shareholders. The corporation pays no tax. It's called a flow-through or a pass-through organization. The income, let's say I own 10% of a company that makes $100,000 in income this year, I will be taxed on $10,000, whether they pay me dividends or not. So I'm going to pay the tax at my individual rate, and the corporation is not going to pay any tax. So that eliminates the double taxation problem. LLCs and sub-S's are very popular in small to medium-sized businesses because individual owners don't want to be subject, or small businesses, small business people don't want to be subject to double taxation. So they set their organizations up as LLCs, usually, sometimes sub-S's, in order to eliminate that double taxation problem. Now the companies earn the money, they get taxed on it. Doesn't necessarily mean that they pay that money out to themselves. They may well leave it in the company to grow the company, but they're not subject to double taxation. I can tell you that the companies that I ran were mostly LLCs, though I had a sub S or two. Never had a C Corp because C Corps didn't make sense for somebody in a small business situation where with one or two or three primary owners. And what I did was I made sure that I received enough from the corporation to at least pay my tax on the money that I was being taxed on from the corporation. I might leave everything else in the corp, but I would take enough cash out of the corp to pay my taxes on the income that I was being taxed on. And that's the way most small business people would act. There are some very large LLCs as well. But some LLCs are publicly traded. You can buy LLCs, but just remember that you're going to be taxed on their income, whether you actually receive any dividends to pay the tax or not. Dividends. Growth companies often keep their earnings and don't pay out dividends because they are growing fast and need the capital, and they think that they're investing the capital more efficiently than their stockholders would be able to. So they retain the earnings and don't pay dividends. Stable companies, sometimes called blue chips, are more likely to pay dividends. So companies that are generating a lot of cash and don't have as much growth, so they don't need as much capital, are likely to pay out higher dividends or dividends at all, whereas growth companies often don't pay out any dividends. From the stockholder standpoint, so a company that retains earnings rather than paying them out may not be a bad investment, because if they invest those earnings well and the company grows, the value of the stock will grow. When the value of the stock grows, the stockholder who wishes to receive cash can sell stock and receive an increased share price. So if you need the cash, which you would get from a dividend, you can sell some of your shares and receive a higher amount, and that amount is actually taxed favorably as a capital gain, so it's taxed at a lower rate. And the stockholder who chooses not to sell has increased value, or essentially income, and doesn't get taxed on it at all until such time as he needs to sell or decides to sell. So there's some advantage to investing in companies that don't pay dividends, because presumably if they're well run, they're going to grow faster, and the value of their stock will grow as well. Receiving dividends can also be valuable. Oops, what have we done here? Change the format a little and you can't see. There we go. So if you're receiving dividends, a lot of investors like dividends because it's a steady and relatively dependable flow of income. It's taxed to the recipient and is generally a slightly lower tax rate on dividend income than there is on regular earned income or interest income. And if you happen to own, if the stock is actually owned by a tax benefit entity like a 401k, then the dividends are untaxed until such time as you take the money out of your 401k when you retire. So the dividends come through as untaxed income, like everything, all the other income in your 401k, and that's a benefit to dividends in a 401k. And dividends are paid by companies that can invest earnings at a high rate of return. So they are in an industry that isn't growing. They don't need as much capital as they're generating cash, and therefore they choose to pay out dividends. So what we call that return is the total investment return on an investment in stock is the dividends received plus or minus the appreciation or depreciation of stock value. So if the stock is appreciating in value, the stock price is going up, and I'm receiving dividends, I want to add those two things together to calculate my total investment return. And vice versa, if the maybe I'm not receiving dividends and the stock is appreciating, that's my return. Or if I'm receiving dividends but the stock value is falling, then I have to subtract the fall of the value of the stock from the dividends that I received to get the total return. So that's a beginning here. I'm gonna break it here. We've got a lot of material to cover in this chapter, and there'll be a second and maybe a third lecture for this chapter. So answer the couple of questions following this, and then we'll go on with more information. Thanks.